On Wednesday, there was a relief rally here on the ASX after the inflation numbers for October showed a surprising fall in the consumer price index. So are things really getting cheaper? And how long will this rally last? I caught up with June Bailu, the portfolio manager at Tribeca Investment Partners, a little earlier.
Certainly looks to be the case, but look, one word of warning, I don't think it would drop significantly that quickly either. So just based on the commodity prices and things that a lot of those outlooks sort of stabilize somewhat. So it's likely to be drifting lower, but it's still going to remain reasonably high. Interest rate increase, which is the next question, is it still going to be on the cards, but perhaps not as aggressive as it was over the last 12 months.
It feels like markets are looking for any signs of positivity, and when there is something, they will just spurt up really quickly. Is that kind of your reading into it as well?
Oh, absolutely, because the market has been very, very bearish or pessimistic for the pretty much last 6 months when the Aussie market has been rallying. Last 6 months, so many of my investors always ask me, oh, what do you think about this bear market? And yes, it was bear market for the NASDAQ, but for Australian equities, our market's done incredibly well. It's gone up in double digits since July. It's actually been a fantastic environment to stock pick and find good investments. So, our market is actually doing really well. Now we're heading to Christmas. This, Santa rally is taking place. And a lot of bearish investors sort of, they just didn't position properly. And now they have to cover some of their shortfalls and be part of that rally.
This week, we've also seen a pretty big rise in the United States after US Fed Chair Jerome Powell basically said interest rates are going to rise at a slower pace. Do you think things are finally looking positive in America now as well?
Look, America is looking a little bit better, but still, we still have the earnings downgrade to come for Americans. We have seen the forward indicators for consumer, for corporates, and then for the job market is looking quite weak. And rest can be assured, by March quarter, we will see a lot of corporates downgrading earnings, and then the consumers really tightening their belt on the back of really substantial increase in interest rate. Their interest rate has gone up much, much more than ours. So, their consumer will feel the pinch a lot more, and the forward indicators really saying that. So if anything, March quarter, we will see some weakness across the US for sure, and the share market might create a bit more volatility.
The other thing we saw this week in Australia was retail sales in October declining for the first time this year. Is this a bit of a warning sign for the retail sector as we head into Christmas?
Look, it certainly is. And if you're like me, paying attention to all the Black Friday sales, it certainly seems like the sale has been quite aggressive, and many of the sales has been extended. So, we should see this long period of aggressive discounting heading into Christmas as a retailer clear a lot of the extra inventory that they bought. Remember, we had the supply chain issue. All the retailers went out, bought a lot of inventory, and they're counting on discounting period to really clear those inventory. So for shoppers, hold out and buy really cheap stuff that's coming up. And but for retailers, it's going to be a challenging period, especially the discretionary retailers.
Do you think their share prices will then be under pressure then for the rest of this month, going towards the end of the year? Or
look, absolutely. I think for retailers, it's really difficult to see how their share price will outperform in the next 12 months, to be honest. Look, one is that they were making, people bought too many things during COVID, and now people want to spend on services. Two is that consumers going to tighten on some of the discretionary end. So all that together just means that things are going to be pretty tough for them, even though they're not cheap. They're not expensive. So, but that's not a reason to buy, because earnings going to come down, which means they're actually more expensive than they appear.
The other thing that is expensive right now is some of the major banks. Commonwealth Bank's shares are at about $108 at the moment. Do you think the banking sector has reached its peak this year?
I think it has. Commonwealth Bank certainly has. My view is that Commonwealth Bank is it's trading in an unusual pattern compared to the previous, decades. Normally, the banking sector trade very closely linked with each other, whereas Commonwealth Bank, for the last 12 months, has performed incredibly strong. It's really thanks to, it's a great business. It runs its business very well, and also high interest rate, clearly, but also thanks to a lot of offshore buying. When offshore investors look global share market, they look at Australia thinking, wow, this is incredible. They've done so well, and Aussie, our currency has become very cheap. So the entire Australia was on sale. So there was a lot of inflow buying into Australia, and Commonwealth Bank is one of the largest things, the first thing they will buy. So it has really benefited a lot in terms of that capital inflow. But the challenge is, if going to next year, our economy is going to slow somewhat. It's going to be okay, but it will slow somewhat. And the banks already had all their margins upgrade. So the good news is already in the price. Commonwealth Bank is very hard to see share price going higher.
What are some sectors you're liking at the moment? I know tech stocks, they're down about 30% this year. Is that sector coming back into vogue now? It looks like interest rates are starting to even out.
Yeah, absolutely. So tech, even healthcare is a good place. So most of they call it long duration. So growth company that can give you defensive structural growth will come back into vogue because, like you said, interest rate is already as high, or the expectations of interest rate already as high as it is. And, if anything, it might potentially be tempered somewhat. And then as the economy heading into slowdown around the world, except China, people will be cautious about buying, the other companies that's exposed to economic growth. So, growth company will come back in vogue, and if not already so. And for those that can hold their earning, like the healthcare, will do really well. And then this is one thing I think people often say, is it time to buy NASDAQ? Be very careful with NASDAQ because most of NASDAQ tech companies, it's not just tech, growth company, they actually consumer tech. So these are the companies in a consumer slowdown, their earning will be impacted. So if you're going to have earnings downgrade, share price still going lower. So I actually think for NASDAQ, it's going to be a challenging period just because earnings still coming off. Whereas for some of the structural growth leader like CSL or ResMed or Technology One or NextDC, these companies will do relatively well.
You mentioned China's economic growth. It looks like they're starting to relax their COVID restrictions with a couple of problems along the way. But how positive is that going to be for Australia and markets here if COVID zero does come to an end?
Look, it's incredibly positive. We are a direct beneficiaries of China reopening. When they do reopen, they will consume more goods and consume more of our commodity. That is very beneficial for us. And especially now with the relationship thawing between Australia and China, potentially there's a few other new areas that we can move into. And put that aside also, China coming back is really beneficial for the global economy because over the next 12 months, US as the largest consumer in the world, they are going to slow down, if not recession, but maybe a mild one. But China, being the world's largest supplier, is coming back online. So that means the inflationary pressure will ease under that sort of scenario, and that's great for everyone. And given the growth that China will deliver over the next 12 months, when it does reopen, it will perhaps offset some of the slack that the other economies are now slowing.
And just quickly, what are some sectors that you're not liking right now, apart from retail?
Yeah, so obviously consumer is the one that you have to be really careful of. I do believe that some sectors you do have to be careful of, especially if they're the red hot sectors. Things like lithium, they have done incredibly well. You made your money if you're in there, there is a lot of heat in those businesses, clearly the long-term thematic is intact. So there's a lot of EV demand and things, but for the short term, the lithium prices have gone through incredible rise in the last 12 months. So it's perhaps time to really take some profit. And as you'll see more and more volatility about what's China's EV sale, and it was down last month, and then suddenly you see those stocks come off 10%. So these stocks will become more and more volatile as we head into an environment where you have more check on what is actual ultimate demand.
Jun Bei Liu from Tribeca Investment Partners, thanks so much for your time today.
Thank you for having me.